Okay, so if you've ever built an automated trading strategy, you probably know this feeling, right? That gut-wrenching moment.
Oh, yeah.
You spend hours, days, maybe weeks. The back test, it looks absolutely stellar.
Yeah.
Like perfect 45-degree equity curve, just beautiful.
The dream curve.
Exactly. And then the second you plug it into the real market, poof, it just collapses. It works great up until the moment it really matters.
It's incredibly frustrating. And look, the core issue usually isn't that the idea was never good. It's more that the strategy lacked, well, robustness.
Robustness, meaning
Meaning it was just too fragile. It couldn't keep performing when the market conditions inevitably changed, shifted away from that perfect slice of history you built it on.
Right. It was optimized for a past that isn't coming back exactly the same way. And that fragility. That's why we're diving into something today that honestly feels a bit weird for finance.
Six Sigma. Yeah, it sounds industrial, doesn't it?
Totally. When I hear Six Sigma, I think, I don't know, making computer chips or car parts.
Yeah.
Not trying to predict the NASDAQ Q.
And you're spot on, historically. Six Sigma came out of manufacturing, specifically Motorola back in the 80s. It was designed to do one thing really well, cut down defects and control variability on a production line.
Okay.
So our mission for this deep dive is to show you how that same super rigorous data-driven method, specifically something called the DMAIC cycle, can actually be applied to building trading strategies.
DMAIC, define, measure.
Define, measure, analyze, improve, control.
Yeah.
The idea is to move away from just intuitive design, hoping for the best, towards a real system, quantitative process management for strategy building.
Okay, let's unpack that because this sounds like a big shift. We're not looking for the mythical holy grail strategy anymore, the one that never loses.
No, not really. It sounds like we're aiming to build a robust system for finding strategies. Strategies that are inherently more stable because the process that made them is stable.
Ah, I see.
Exactly. We're treating the whole strategy generation process itself like it's the production line. And that's what needs the quality control.
Because if the machine building the strategies is flawed,
then every single strategy that pops out is potentially flawed, right?
Right.
Doesn't matter how good that first back test looked, it's destined to fail eventually.
So we're managing the inputs, the rules for how we find strategies, not just tweaking the final code.
Precisely. And that takes us straight into the first phase of DMAIC, define.
Define.
Okay. Now, usually when someone starts out, what do they chase? High profit factor, right?
Yeah.
Maximize the gains.
Yeah, biggest number wins.
But Six Sigma flips that on its head. It says you have to define the defect first. What does failure actually look like in this process?
Okay, so in manufacturing, a defect is easy, right? A cracked phone screen, a faulty part.
Right.
In trading,
Yeah.
what's the defect? Is it just hitting zero in the account? Because that feels a bit late.
Way too late. We need a much, much tighter definition. A defect is any output, any strategy generated that falls outside your predefined statistical tolerance limits.
Okay, like what? Give me an example.
Well, it could be, say, a loss hitting more than 20% from your account's highest point, or maybe excessive drawdown under specific market volatility, or maybe just really inconsistent monthly results. Low PL consistency.
Okay, so it's about stability.
Exactly. The goal immediately shifts. It's not about chasing the absolute highest profit anymore. It's about producing strategies that reliably operate within acceptable statistical boundaries. We're emphasizing stability over just raw aggression.
That makes a lot of sense. Define what bad looks like before you start measuring good, which naturally brings us to M measure.
Measure. Yep.
In the factory, they're measuring defects per million opportunities, DPMO. It's a hard objective standard for quality. How on earth do we get that kind of quantitative QC into the messy, chaotic world of algorithmic trading?
It's definitely a challenge, but the principle applies. We quantify the quality of the strategy itself and, crucially, the quality of the process we use to create it. We look at metrics beyond just simple profit. Well, sure, profit factors in there, but also things like the R-squared of the performance curve.
R-squared, remind me.
Basically, it's a statistical measure of how straight and smooth your equity curve is. A high R-squared suggests more reliable, consistent performance, less jagged ups and downs.
Okay, consistency metric. What else?
And then we get into deep stress testing, things like Monte Carlo stability analysis.
Right, Monte Carlo is crucial for robustness checks. Can you just quickly explain for anyone listening what that test is really measuring?
Absolutely. Monte Carlo is essential here. You're basically running thousands of simulations where you slightly mess with the past data or the trade execution.
How so? Like adding noise?
Yeah. You introduce random variations, maybe slight changes in historical prices, randomizing slippage, shuffling the trade order, things like that. You're testing,
Yeah.
does my strategy still work if history wasn't quite so perfect, if execution isn't flawless?
Okay, so it tests resilience to randomness and imperfection.
Exactly. And if the strategy still shows positive results, across maybe 80% or 90% of those thousands of random simulations, then we consider pretty robust.
Now that sounds like a measurable output for a strategy. So let's connect this back to measuring the process. How do we set that Six Sigma target, like the famous 3.4 defects per million for strategy generation? Because honestly, getting that precise in trading feels kind of impossible given the market noise.
That's a really fair point.
Yeah.
And yeah, achieving literal 3.4 DPMO in trading is probably unrealistic. It highlights the challenge of applying manufacturing ideas to a system with so much inherent randomness.
So we adapt it.
We adapt it, but the principle holds. We set a realistic but still rigorous benchmark. For example, we might define that our strategy building campaign, the process run, must yield, say, at least 95% of strategies that survive a tough Monte Carlo test and still end up profitable.
Okay.
Now, if our current building process only spits out strategies where, say, only 70% pass that test, well, that 30% failure rate, that's our production fault.
Ah, I see. The process itself isn't meeting the quality standard.
Precisely. It means unwanted variability, some kind of inconsistency has crept into our system, just like a fault on the factory floor.
What's really hitting me here is how you've shifted the focus. Like completely. We're not just judging individual trading strategies anymore.
What?
We're measuring the quality of the whole strategy building process itself, the machine that makes the strategies. If that process is unreliable, the output, the strategies, will eventually be unreliable too, no matter how amazing that first backtest looked.
Exactly right. Which logically moves us into the next phase, analyze. The A in DMAIC.
Analyze. Okay, so our process is only getting 70% of strategies through the robustness test. We need to figure out why. Where's the inconsistency coming from?
Right. We need to pinpoint the sources of this variance.
My first thought would be, human error. I used the wrong data file, or I clicked the wrong setting somewhere. Simple mistakes.
That can happen, sure. But Six Sigma pushes us to look for systemic faults in the process itself.
Systemic? Like what?
Well, common sources of process variability and strategy creation often include things like excessive optimization.
Curve fitting, basically.
Yeah, tailoring the strategy way too tightly to specific noise patterns in the past data. Or maybe using too narrow a market selection, only testing on one specific index during a bull run. Poor data granularity can be an issue. Or relying too heavily on really complex, unique combinations of filters.
Let's stick with over-optimization for a second. How is that like process variability in manufacturing terms? Help me visualize that.
Okay, think of it like this. Imagine a machine on the factory floor. It's been calibrated perfectly, but only for one very specific batch of raw material.
Okay.
So for that batch, it produces flawless products. But then the next truckload of material arrives, and it's slightly different, which is normal. Materials vary. Suddenly, the machine starts churning out defects. Why?
Because it was too tightly tuned. It had no tolerance for variation.
Exactly. Over-optimization in trading is the same thing. You've calibrated your strategy so tightly to a specific, narrow historical period, maybe even just noise. The moment the market introduces a new variance, a different regime, higher volatility, whatever the strategy breaks because it has zero tolerance. It wasn't built robustly.
Okay, that makes sense. Can you give us a concrete example? Like, what might an analysis tool actually show us that flags this lack of robustness?
Sure. Many analysis tools, like StrategyQuant X, for instance, calculate a composite score, sometimes called a robustness index or something similar.
Right.
This index essentially scores how well a strategy survives, being tested across lots of different historical data segments, different start dates, maybe varied parameters slightly.
And what flags a problem?
Well, if your analysis shows that your successful strategies are heavily reliant on a very specific, very narrow combination of indicator settings, like it only works if the RSI is between exactly 32 and 34, and a moving average crossover happens within 2 DARs, but it fails everywhere else.
Okay. That screams curve fit.
It screams low robustness. That high dependency on super narrow criteria tells you the process is generating strategies that likely only worked on one specific, maybe random historical data pattern, not a generalizable edge.
Okay, got it. So we've defined the defect, for failing robustness tests, measured the process fault, for example, only 70% pass, and analyzed the source, for example, over-reliance on narrow criteria due to over-optimization. Now we get to improve.
Improve, yes.
And we need to stress this point again, right? This phase is about fixing the strategy creation process, not just tweaking the stop loss on the final strategy we liked.
Absolutely critical distinction, yes.
Yep.
This is about stabilizing the inputs and the methods we use to select strategies during development.
So how do we do that? How do we improve the machine?
We can start introducing new rules into the process pipeline itself. For example, we could set a strict criterion for minimal variance between the in-sample results, the data used for initial discovery, and the out-of-sample results, the unseen validation data. Meaning, if a strategy looks great in sample, but then performs, say, 50% worse out of sample, we automatically throw it out. It doesn't matter how good the initial numbers looked. The process rejects it based on that performance drop-off.
That sounds like a really powerful quality filter built into the process. What else? How else do we stabilize this production line?
We definitely need to expand the data foundation we build on.
More data. Longer history.
Not just longer, but more varied. Instead of testing over just, say, a 5-year period that was mostly bullish, we make sure the process requires strategies to be tested across multiple market regimes. Bull markets, bear markets, sideways chop, periods of high volatility, low volatility.
So we're improving the machine's tolerance by feeding it more varied input, like making the factor machine handle different batches of material.
Exactly that analogy. We also need to rethink our selection strategy within the process. Instead of just grabbing the top 1% of strategies based purely on profit factor or Sharpe ratio.
Which might be the most over-optimized ones.
Very likely. Instead, we might shift to statistical selection. We can say only consider strategies that fall within the top, say, 10% based on their robustness index score or their Monte Carlo stability.
Ah, so you're selecting for stability first, then maybe looking at profit potential within that stable group.
Precisely. We select strategies not just because they have the highest theoretical profit in a perfect past, but because they belong to the statistically most stable, most resilient group.
So you're deliberately filtering out those high-risk, high-reward outliers, the ones that look amazing but are probably fragile. It's like accepting slightly slower production speed in the factory to guarantee every unit meets the quality standard.
That's a perfect way to put it. These kinds of process improvements, better data, stricter validation rules, stability-focused selection, they stabilize the whole thing. They significantly cut down the chances that your good results are just pure luck, just randomness. You're engineering stability into the production line.
Okay, makes sense. That brings us logically to the final phase, the C and DMAA, control.
Control. Yeah, and arguably the most vital in the long run.
Because if we build this great process but then just walk away,
It'll eventually drift. It'll regress back towards its old, uncontrolled, maybe chaotic state. Markets change, data feeds change, things happen.
So control is about keeping it on track.
It's all about ongoing monitoring after you've improved the process and deployed strategies, maintaining that stability, preventing the regression.
How do we do that in trading? Set it and forget it doesn't work here.
Definitely not. We use methods like continuous walk-forward analysis, where you're constantly re-optimizing and revalidating on new data. Live monitoring dashboards are key, portfolio stability visualization tools.
Okay, standard practice for serious quants. But how does Six Sigma add its specific flavor here? You mentioned control charts earlier.
Right. If you want to be really rigorous, truly Six Sigma about it, you apply control charts to the process outputs over time.
Control charts for trading metrics? How's that work?
Well, you could track, say, the average robustness index score coming out of your strategy building campaigns each month, or track the average maximum drawdown of your portfolio of deployed strategies.
And then?
You set statistically determined upper and lower tolerance limits on that chart, based on past performance when the process was deemed in control. If that average robustness score starts trending down, or the average drawdown starts creeping up towards that upper limit.
Ding, ding, ding. Warning bell.
Exactly. It signals a potential loss of process quality. It's your early warning system. Maybe underlying market dynamics have shifted fundamentally. Maybe your data provider quality is degraded. The process itself needs to be re-examined. Maybe even go back through, analyze, and improve.
So crucially, you're not just monitoring the P&L of one strategy going bad, you're monitoring the statistical health of the system that generated the strategies. If the average deployed Sharpe ratio starts to degrade outside a preset acceptable range, the system flags it. You don't wait for a margin call to tell you something's wrong.
The factory machine is basically telling you it's going out of calibration before it starts making garbage.
Okay. Now, we absolutely have to tackle the elephant in the room, the thing that haunts every quant trader. The data mining trap, or data mining bias.
Ah, yes. the curse of randomness.
We generate millions, maybe billions of strategy variations. We know statistically that some of them are going to look amazing purely by chance, right? They just happen to fit the noise perfectly. How does Six Sigma deal with this fundamental problem? Is it just unavoidable?
Six Sigma actually has a very clear perspective on this. It views data mining bias not as some unavoidable mystical force, but as a fundamental, well, process error.
Or process error.
Yes,
Yeah.
it's seen as being caused by uncontrolled variability in your development process. If your process is so loose, so uncontrolled, that you have to generate a million random strategies just to find 10 that look good and survive some basic tests, your process quality is incredibly low. You're essentially relying on brute force luck.
Which is the opposite of control.
The absolute opposite.
Yeah. So the answer isn't just, okay, let's generate 10 million strategies next time then.
No. Definitely not. The Six Sigma solution is rigorous control and setting measurable output tolerances at every single step of the process. Remember that 95% Monte Carlo pass rate benchmark?
Yeah.
If 90% of the strategies your process generates are failing that basic robustness test, the problem isn't that you didn't generate enough random variations. The problem is that the build process itself is low quality. It's producing fragile outputs.
So by improving the process using the analyze and improve steps we talked about, like ensuring varied data, constraining optimization, using stability filters.
Exactly. By doing all that, you should need to generate far, far fewer strategies to find ones that are genuinely stable and robust. It replaces the desperate hunt for luck with a systematic demand for statistical quality.
Wow, okay, this has been a really illuminating deep dive. Let me try and recap the big benefit here for you, the listener. Applying these Six Sigma ideas seems to bring real discipline, measurability, and control to strategy creation.
Yeah, I think so.
It transforms it from what can feel like a very experimental, often frustrating hit-or-miss activity into something more like a managed, quality-controlled system.
And the outcome, ideally, is strategies that are statistically stable, because the method you used to find them was designed for stability. By focusing on defining the defect early and measuring the process quality, not just chasing flashy backtest profits, you start to move away from the realm of pure chance.
So wrapping this up, what does this practically mean for someone sitting at home right now thinking about designing their next trading algorithm? What's the final takeaway?
I think the final provocative thought here, maybe borrowing from the core idea, is that true robustness isn't really found in just getting a slightly better backtest score.
Okay.
It's achieved by creating a stable development system, a system that builds strategies designed to survive and perform, even when the market inevitably changes, maybe fundamentally changes around it.
So the focus is the system, the process.
Always. Ask yourself this. If you redefined your best strategy, the one with the highest Sharpe A ratio, as a defect simply because it failed a rigorous statistical stability test, how many of your current strategies would you have to discard?
Oof.
That's a tough question. It is. But the goal is to reach a point where you survive and thrive, not because you got lucky on one or two strategies, but because your production system consistently minimizes errors and produces statistically sound results. That's the Six Sigma way applied to trading.